Hey there, and welcome back to another episode of the DGI Crab. This is the Friday episode, y'all. This is the episode where I go through all of the stocks that this channel focuses on and see where we can find value. The DGI Crab channel is all about investing in dividend growth stocks based on your age. So I've selected 60 of the most high quality dividend growth stocks out there, broken them down into 4 different tiers based on your age. The aggressive growth compounders being down for the younger folks, and the old folks get to look at the higher yielding, slower growth stocks for the immediate income, and then everything in between. So here we are on July 12th, 2024. We're going to go through each of the 4 tiers on the list and see where we can find some value. But before I do have to preface this by saying that I am not a licensed financial advisor. The opinions expressed in this video are just this one crab's opinion. This is the strategy that I use to simplify investing and acquire passive income with a regular plan and strategy. You should always, however, do your own due diligence before investing in any stock or security. So with that, let's jump right into it. So as we do, we're going to start here with the tier 1 investors aged 18 to 30. Stocks in the green category here are in the major undervalued category. So if they're 30% or more off of the 4-year average yield, they're green. 20 to 29.9, they're in the yellow, and 20% or less in the red. So what I do here is I focus in on the green. And in the 18 to 30 category, out of our 16 stocks here, there is one screaming undervaluation here, and that remains to be Nike. Nike is the story of the channel so far. The very first one that I did 2 weeks ago today was when Nike had their epic drop from the low 90s all the way into the mid 70s. And they are still sitting here at approximately a 95% undervaluation based on the 4-year average yield versus the current yield. 4-year average yield has ticked up 1 basis point. I do update this every single week to make sure that we are as accurate and up to date as possible. Currently yielding almost twice that at 2.02, and it did get even higher than that. This was a 100% undervaluation during the middle of the week. And what is that I smell? Is that fear? Is that fear that I smell around this Nike stock? Fear smells delicious to this particular crab because this is the time that I swoop in and buy quality companies. Nike just reaffirmed on Safely SIF Dividends has a perfect 99 safety score on their dividend, so seems to be very little concern that this dividend gets slashed. I think this is still a major overreaction from the market, and so long as Nike is sitting down here in the mid to low 70s, it's definitely one that I'm buying each and every week, and I'm just amassing a larger and larger Nike position while it is down. And that is what dividend growth investing is all about, everybody. You're buying up stocks when other people are just running scared from them. Prior to launching the channel earlier this year, I was buying up Archer Daniels Midland stock when it dropped into the low 50s because they had to fire a CFO. I was buying up shares of Air Products and Chemicals a month after that when they reported a bad quarter and their share price dumped all the way down into the 210s. And both of those have recovered since then. I'm feeling pretty darn good about those investments, and I think Nike's going to have a turnaround story as well. Not a lot of tremendous value beyond that. Nordson has recovered a bit. We could have gotten that last week or earlier in the week in the mid 220s. It's jumped up into the high 230s. Still not a terrible buy, but I liked it better at 1.2% than 1.15. United Health and Kroger still not too bad of a deal, but this was just a major green day in the market. Still waiting on automatic data processing and Visa to just drop a little bit lower. And then Lowe's. Last week I was talking about when Lowe's eclipses 2%, I start taking a look at it, and Lowe's went on a rally here, and now it's all the way down to 1.88. So, at these prices, I'm waiting on Lowe's. But again, the story on this particular tier is and remains Nike. Moving along to tier 2 for the age 31 to 41-year-old investors, we've still got 4 stocks here in the green. Starbucks has moved into the number 1 spot over Hershey as the most undervalued on the list, and I was definitely adding both Starbucks and Hershey and McCormick this week, along with Nike. I like all 3 of these stocks. And again, listen, there's going to be people that say, no, don't buy those. They're going through bad times. They're never going to recover. Well, listen, the reason that they are on my tiers is because I believe that these are all stocks that have a long track record of success, and they have big time market caps. Most of them are wide moats, so I am all about buying them when they're on sale. I can acquire $2.28 of forward income for every share of Starbucks stock that I buy right now, and I'd rather buy that in the $74 range than the $94 range whenever it ends up recovering. So Starbucks here at the top of the list, followed closely by Hershey, which is still looking quite undervalued to me, followed by McCormick, followed by Target. American States Water was in the green last week. They went on a run, and now now that they've jumped up to 77 here, I've got them more in just the okay buy range. But I'd probably wait on that one as opposed to if I can get something like Starbucks or Hershey at these valuations right now. If I'm in the tier 1, I think that I typically would not recommend somebody jump up a tier. If you're down here 30 and under, I'd still think it'd be better to focus on those compounders. But if you absolutely desperately wanted to, if something in the tier above hits that 50% undervalued, that's not the worst idea in the world to go and scoop up a little bit. And then conversely, if there's nothing in the green within your age range and you want to jump down a tier and grab more of a compounding stock, definitely not a problem in my eyes as well, which is something, again, that I'm doing with Hershey, or excuse me, with Nike. Nike, as we looked at before, they typically only yield about 1%. That goes back a decade. So if I can get it at 2% right now, why not? And then kind of similarly here with Starbucks, going to take just a quick look here at Starbucks just so we could get a sense of the history here. So Starbucks, if we take a look at their dividend yield history on Seeking Alpha, we're going to go back to for the last 10 years here, dating back to 2014, and we could see Starbucks a lot of the times is yielding in the 1s, and when it gets up into the 2s, a lot of the times it's on the lower range of the 2s. If you look at the max yields here, going all the way back to 2014, the highest the yield had gotten prior to this year was 2.75%. And right now we can get it above 3%. So that's why Starbucks to me just looks like such a screaming buy. Again, that is not investment advice. That is just this crab's opinion, and it's something that I am buying. Moving into the tier 3 category. Oh, and by the way, real quick before we move on, McDonald's, I mentioned last week, McDonald's is one that when it gets into that yellow category, into the 20% undervalued range, I typically jump on it, which I did a week ago. And then McDonald's is starting to recover. So we may have lost our opportunity to get McDonald's cheap. We'll see. We'll see what it does. But it moved down into the red here just barely. All right, so tier 3, age 42 to 53. Again, Hormel Foods sitting up here at the top of the list. I didn't jump up and buy any Hormel this week, although, because I'm in the tier 2 down here in the 31 to 41. This is definitely a major bargain in my eyes. Hormel's just had a really, really tough year, and I think that they are going to eventually recover and not be down here in the low 30s. I don't know how long it's going to take, but so long as they are sitting here, I'm still liking that 3.65% yield when the 4-year average is 2.42%. And in previous years, it hasn't even been as high as 2.42. So I'm really liking where Hormel is at right now. The other green that we have here is Medtronic. Medtronic's just kind of been lagging along since COVID. And they haven't been doing as strong of dividend increases the last couple of years as we've maybe gotten used to, but they still have an excellent payout ratio, 52%, should be a very, very safe dividend, 47 consecutive years of growing that dividend. And I like it here at 359, 3.6, good safe yield to acquire. It doesn't feel as big of an anomaly with Medtronic being down here in the 70s. They keep dipping down here and there over the last few years, but you buy good quality companies when they're on sale, and Medtronic still looks like a good deal to me. Archer Daniels Midland just fell out of that green category. They're continuing to do a bit of a rally. Still not a terrible deal. American Tower's been in the green each of the last 2 weeks I've done this video, and they really shot up on news that maybe rates are getting cut because the high interest rates are killing the REIT sector, as I've mentioned before. And American Tower definitely recovered a bit on news of the maybe possibility that rates get cut. So we'll see. Johnson & Johnson, one of my top 10 favorites, sitting here still in the yellow at 22.5%, undervalued on the 4-year average yield. Pepsi was there last week. They slipped out of that category and moved back down here into the red. I absolutely love both of these stocks. And Johnson & Johnson in particular, as long as it's sitting down there below 150, fine investment for somebody in their early 40s all the way up through to the early 50s. Just one of those super steady stocks you just don't have to worry about. They usually yield about 2.7%. Right now you can get them at 3.3%. So plenty of upside there, higher yield than you can usually get them at. Just one of the absolute best dividend growth stocks that are out there. And then we move into our tier 4 category, 54 and up, and wah, wah, wah. It just gets worse and worse for our 54 and up investors. The high yield stuff just has not been on sale for a while now. Realty Income, everybody's favorite REIT, has been yielding a lot closer to 6% than the first couple of Friday videos that I did here. Just like American Tower, their price is recovering too. So while 20% undervalued isn't terrible, it's not great, because the problem with the REITs is that this dividends taxed as ordinary income, not qualified income. So you kind of have to factor that in when you're doing a purchase too. And Verizon about to go ex-dividend. Maybe this drops a little bit past the dividend date and it becomes a little bit better of a buy, but nothing on here is really jumping out to me as just a can't miss. And when you're in this 54 and up age range, you're purchasing single stocks as opposed to ETFs. I think you really need a darn good deal, and not reach on to get yield from a single stock. Just be patient. Wait for them. At some point, you're going to have a good deal. And if you want to drop down into the 42 to 53 tier, grab you some Hormel or some Medtronic. I know that the yield in the mid threes isn't as attractive when you're wanting to try to get stuff that's closer to that 5% range or better, but at least you can get probably better year over year growth than you're likely to get out of any of these on the list. And just real quick, if we take a quick look at the ETFs that you might consider here in this age range, as I was looking at some of the higher yield ETFs like DHS, SPYD, DIVO. I mean, a lot of this stuff is offline in terms of the 4-year average. Also, now your high yield bonds, SPHY, certainly doesn't look bad. Now it's yielding in the high 7s, and I'm going to defer here real quick to our friends over here at Forbes, where they break down, and I'll put a link to this in the description below, the high yield bond market and their favorite high yield bonds, the ETFs. They use a methodology here to explain how they get to them. And when I went through and double checked these today, reaffirmed to me SPHY is still my absolute favorite in this category. I am certainly not a bond expert, but it's super low expense ratio, very diverse. And it is, as they say here, fairly well suited for the current rising interest rate environment. So maybe if you want to grab a safer, higher yield now, you could get something like SPHY at almost 2% higher than the 4-year average yield it has. So that's going to wrap us up here for the day. My name is Colby, the DGI Crab. I hope you had a great investing week and that this will give you some ideas going into next week. You can go into next week and attack investing with a plan. Links to videos explaining each of the 4 tiers below, and I'll see you